70% of Berkshire Hathaway's entire $313 billion public equity portfolio. Sitting in just 5 stocks. This just dropped, and most investors don't realize what it means yet. Here's what's really going on, and what you should be thinking about right now. Because if the greatest capital allocator alive is betting this heavy on this few names, you need to know exactly what he sees that you might be missing. 5 stocks. That's it. Apple, Bank of America, American Express, Coca-Cola, and Chevron, together representing roughly 70% of Berkshire's entire publicly disclosed holdings. Apple alone accounts for approximately 28% of the portfolio, a single position worth north of $87 billion. One stock, one bet. Bank of America sits at number 2. Roughly $33 billion, or about 11% of the total book. American Express has been in Berkshire's portfolio since 1991. Buffett paid roughly $1.3 billion. That position is now worth over $40 billion. That's a 30-bagger, held through crashes, recessions, and rate cycles. Meanwhile, Berkshire is sitting on $334 billion in cash and treasury bills. A record. While retail investors were chasing momentum trades, Buffett was hoarding dry powder at the highest level in Berkshire's history. And here's the kicker. Greg Abel, Buffett's designated successor, is increasingly fingerprinted on the newer moves. The next chapter of Berkshire is already being written. But here's what nobody is saying about this yet. Every personal finance course on the planet tells you to diversify. Don't put your eggs in one basket. But Buffett has always called diversification protection against ignorance. His words, not mine. The mainstream take is, Buffett is concentrated. That's dangerous. Don't copy him. The smarter take? Concentration isn't the risk. Uninformed concentration is the risk. Buffett isn't concentrated because he's reckless. He's concentrated because he's done the work that 99% of investors haven't. These aren't random picks. They're businesses he's studied for decades. With durable moats, pricing power, and management he trusts with his life. The real question isn't whether you should hold 5 stocks. It's whether you know your 5 stocks as well as Buffett knows his. First, audit your own concentration. If your top 5 holdings represent less than 40% of your portfolio, ask yourself whether you actually have conviction, or just noise. Second, separate quality from quantity. Holding 40 mediocre stocks isn't safer than holding 8 exceptional ones. Position size without conviction is just expensive confusion. Third, watch the cash signal. Berkshire's $334 billion cash position isn't a victory lap. It's a warning. Buffett doesn't hold that much cash when he sees obvious opportunity. He holds it when he thinks the market is priced for perfection. Here's where I land. Buffett's 70% concentration isn't the lesson. His 50 years of preparation to earn that concentration is. Retail investors who copy the portfolio without copying the homework are playing a dangerous imitation game. Berkshire's cash pile is the real signal here, not the stock picks. Agree or disagree? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.